Capital gains taxes are going up for some Canadians, but there's a lot of confusion among investors and cottage owners about what it all means. Ottawa says it's only targeting the 0.13%, but could it affect a wider segment of the population? What do the changes really mean, and how could it impact you and your summer oasis? We're talking cottages and capital gains on the Upside Plus. I'm Bryan Borzykowski, and welcome to the Upside Plus. On April 16th, the federal government surprised many Canadians by raising capital gains taxes. Let's take a look at what's changing. Capital gains taxes are triggered when you sell an asset like a stock, bond, or second property that's held outside of a registered account for more than you paid for it. Prior to this change, 50% of your capital gain was subject to tax. It didn't matter if your gain was $5,000 or $500,000. You would only have to pay tax on half your gain. That 50% inclusion rate remains the same on any gains realized below $250,000. To be clear, that doesn't mean you're losing half of your gain to tax. It's only that portion of your gain that's subject to tax at your marginal rate. What's changed is that you now have to pay tax on 66.7% of any gains above $250,000. That means every dollar over that threshold is subject to more tax. How will this impact individuals? Before June 25th, if you had a $500,000 gain, you'd have to roughly pay $90,400 in tax. Going forward, you'd pay around $112,700. That's just over $20,000 in additional tax on a $500,000 capital gain. As well, if you hold assets inside of a corporation, that 66.7% rate will apply to all gains realized, whether above or below that $250,000 amount. As Federal Finance Minister Chrystia Freeland explains, the change is about tax fairness.
The measure that we're putting forward today is, first of all, about fairness. The fact is today, with the tax system that we have in place, a nurse or a carpenter can pay tax at a marginal rate, which is higher than the marginal rate that a multi-millionaire faces.
The move is controversial. Although the finance minister said that more than 99% of Canadians will not be affected by the change, some think there's more of a gray area, especially when it comes to cottages. Here's Fidelity's Peter Bowen, Vice President of Tax Retirement Research, discussing how the change might impact the sale of a cottage that sells for more than $250,000.
You also have to think about people who own vacation properties.
Yeah.
Right? I was talking to someone this morning who by no means a wealthy individual or a high income earner who has a cottage that they were thinking of selling in the near future. This is a big hit, right? Because you think about that $250,000 threshold, it's not hard to have a $500,000 capital gain on a cottage that's been in the family for a decade or 2 decades or whatever the case might be.
Of course, not everyone shares that concern. Here's David Hurley, principal partner at public affairs firm The Gandalf Group, on a Fidelity panel reacting to the budget.
It's not as bad as what people were fearing. There was talk about high income surcharges and there was talk about wealth taxes. And people like David Dodge were saying this looks like it's going to be the worst budget in 40 years. But, I think that this is a pretty limited measure.
But how are families with cottages really responding to this change? Phil Soper, CEO of Royal Lepage, is always on top of all the major real estate trends in Canada. So far, he says, the market reaction has been muted.
It's been relatively quiet from a consumer client standpoint. I would say agents in general feel like it is incrementalism, but it really is audience dependent. In cottage country, for example, there's a lot more concern than I'd say in normal residential urban settings, where people don't think about their homes as an asset in the same way they might with a cottage. And of course, you have on your principal residence, you have tax exemption.
On how the change to the capital gains inclusion rates will be felt across Canada, Soper had this to say.
Most recreational property in Atlantic Canada, in Northern Ontario, in Manitoba, Saskatchewan, it is of a lower value or a lower entry price. And so even the concept of a $250,000 capital gain on a camp outside of Thunder Bay, you'll take a lot of years to get to that level of capital gain. So it's not as big a deal in the recreational properties in secondary markets. In the Laurentians, north of Montreal, in the Muskokas or Kawarthas, north of Toronto, Whistler, Canmore, these kinds of very high value property areas, it's a bigger deal and certainly has people talking.
Here's how Soper would approach this change.
I think it comes back to first principles. Decide what you want in a recreational property. Don't overbuy. Don't find your cottage as a millstone around your neck, but rather something you can comfortably afford. And don't get too hung up on that likely long-term concern you have about the capital gains you might pay on that particular property at this point in time.
The higher inclusion rate could also affect those selling more than $250,000 in stocks or other assets, which could require more sophisticated tax planning. Michelle Munro, Director of Tax and Retirement Research at Fidelity Investments, is with me now. Michelle, thanks for being here.
It's great to be here, Brian.
So what impact do you think the capital gains tax increase could have on investors?
Okay, so in the government announcements, they said it was going to hit the 0.13% of Canadians. So I have a few examples where I think it's going to be more widespread than people might think.
Let's hear those.
So let's think about somebody who has a cottage, maybe a teacher who bought that years or decades ago for, let's say, $50,000 and now worth $500,000. Non-registered asset, they're going to be caught by this change. Another example is think about somebody who has investments inside a corporation. So you might think of some of those higher income earners, professional corporations, doctors, dentists, lawyers, but also plumbers, hairdressers who've incorporated and built up investments inside their corporation. They'll be caught as well. Another example, and this will impact all of us because there's two truths in life, death and taxes. On death, one is deemed to have disposed of all of their assets. So if you're disposing of non-registered investments, they will be caught by over $250,000. They're going to be caught by these changes as well. So effectively, it's an increased estate tax.
So clearly a lot of potential change. What are you hearing from clients?
So we deal primarily with financial advisors, but every day there's multiple questions of how can financial advisors communicate these changes to their clients and help them navigate them as well.
So when you're thinking about selling investments, what are the things that an investor should be considering?
Well, let's start with what is that financial picture? And we're not looking at our registered investments, our RSPs or TFSAs. We're focused on the non-registered investments. Fidelity, we're looking at mutual funds, ETFs, but also those cottages, real property that might have an accrued gain, as well as maybe an art collection as well.
That has not come up.
No, right. So there could be, when it's disposed, could be, if we're over that $250,000, that higher inclusion rate.
So how does this change the estate and tax planning conversation?
Well, it makes it more complicated. So thinking ahead, we have that financial picture. With death, we don't know when that's going to happen, but it is a certainty. So as one is planning for their estate planning, if they think that they're going to be triggered by that higher capital gains, well, let's think about smoothing that, selling that prior to death, keeping it below the $250,000 annually to have that lower inclusion rate.
I'm sure we will be talking about this a lot going forward, but I'll leave it there for now. Thank you so much for being here.
Thanks, Brian.
Now that the change has taken effect, it's time to figure out how higher capital gains taxes might impact your investment, tax, and estate planning decisions. Consider talking to an advisor about your next move. I'm Bryan Borzykowski, and thanks for tuning in to the Upside Plus. I'm going to head to the cottage now.
I'm with you.